Imagine a company showing massive profits, attracting investors, obtaining bank loans, raising public confidence, and expanding aggressively. But behind the scenes, its books of account are incomplete, manipulated, hidden in unauthorized locations, or never properly maintained at all. Suddenly, regulators arrive, auditors raise red flags, directors face investigation, shareholders panic, and financial statements collapse under scrutiny. In modern corporate governance, the entire credibility of a company depends on one foundational legal requirement: proper books of account under Section 128 of the Companies Act 2013. Without legally compliant accounting records, corporate governance itself begins to collapse. Welcome to Corporate and Securities Law Compass, navigating law with clarity. Today, we are discussing one of the most fundamental and powerful governance provisions under the Companies Act 2013, Section 128, dealing with books of account and other relevant books and papers. This provision is the financial backbone of corporate governance. Every audit depends on it. Every investor relies on it. Every board meeting indirectly operates through it. Every financial statement originates from it. Every regulatory inspection examines it. And every fraud investigation eventually reaches it. Section 128 is not merely an accounting provision. It is the legal foundation of transparency, accountability, and financial truth inside corporate law. To understand Section 128 properly, we must first understand a simple governance principle. A company may speak through advertisements, annual reports, investor presentations, and market announcements, but legally, the company ultimately speaks through its books of account. If the books are false, governance becomes false. If the books are incomplete, investor confidence becomes unreliable. If the books are manipulated, the entire corporate structure becomes legally vulnerable. That is why Section 128 occupies such extraordinary importance. Historically, many of the world's biggest corporate collapses began with accounting irregularities. Manipulated records, hidden liabilities, false revenues, undisclosed related party transactions, fake assets, inflated profits, off balance sheet arrangements. When regulators and investigators examine such scandals, the first major legal question always becomes: were proper books of account maintained? The Companies Act 2013 therefore strengthened governance expectations relating to accounting records significantly. Section 128 reflects this philosophy of accountability through documentation. Now let us understand the statutory framework carefully. Section 128 requires every company to prepare and keep at its registered office books of account and other relevant books and papers and financial statements for every financial year, giving a true and fair view of the state of affairs of the company. Immediately, several critical concepts emerge: books of account, relevant books and papers, registered office, true and fair view, financial statements, accrual basis, double entry system. These concepts are foundational to modern corporate governance. Now let us understand the phrase books of account. This is not limited merely to ledgers. The concept is much broader. It includes records relating to all sums of money received and spent, sales and purchases, assets and liabilities, cost records wherever applicable, inventory related records, supporting vouchers, banking records, invoices, electronic accounting systems, and all relevant documentation supporting financial transactions. Now let us discuss the phrase true and fair view. This is one of the most important concepts in financial governance. The law does not merely require records. The records must reflect economic reality honestly and transparently. Creative accounting designed to mislead stakeholders violates governance philosophy. Now let us discuss accrual basis of accounting. Section 128 requires books to be maintained according to double entry system and on accrual basis. This is extremely important. Transactions are recorded when liabilities or rights arise, not merely when cash moves. This improves financial transparency. Now let us discuss double entry system. Every transaction affects at least two accounting elements. This creates internal verification discipline. Double entry accounting reduces manipulation risk and improves financial reliability. Now let us discuss the location requirement. Books of account are generally required to be maintained at the registered office. However, the board may decide to keep them at another place in India. But notice must be filed with the registrar within prescribed timelines. This is a major practical compliance area. Now think practically. If regulators inspect a company and books are missing, incomplete, or kept without proper authorization, governance concerns immediately arise. Section 128 therefore creates traceability. Now let us discuss electronic maintenance, because this area has become extremely important in modern practice. Books may be maintained electronically subject to prescribed conditions. Cloud systems, ERP platforms, digital accounting software, server storage, backup systems, audit trails, all these become relevant. Modern governance increasingly depends on digital financial infrastructure. Now let us discuss rule-related framework. The company's accounts rules become extremely important. These rules prescribe operational details regarding electronic records, preservation requirements, and inspection-related compliance. Professionals must always read Section 128 together with applicable rules. Now let us discuss preservation period. Books of account and relevant papers must generally be preserved for at least 8 financial years. This timeline is critically important. Many companies make dangerous mistakes by casually destroying old records. Now consider litigation realities, tax investigations, SEBI inquiries, fraud examinations, NCLT disputes, shareholder litigation, insolvency proceedings. All these may require historical financial records years later. This is why preservation obligations are so important. Now let us discuss inspection rights. Directors generally possess the right to inspect books of account during business hours. This supports governance oversight. Independent directors especially rely heavily on accurate financial records for decision making. Without proper access to books, effective governance becomes impossible. Now let us discuss branch office accounting. Where a company has branch offices, proper summarized returns and records must still integrate with central accounting systems. This becomes operationally complex for large companies operating across multiple jurisdictions. Now let us discuss practical board meeting relevance. Every major board decision depends upon financial information generated from books of account. Dividend declarations under Section 123, borrowings, investments, related party transactions, CSR spending, managerial remuneration, all depend upon accounting accuracy. Thus, Section 128 indirectly supports almost every governance provision under the Companies Act. Now let us discuss the role of auditors. Auditors examine books of account to verify whether financial statements provide true and fair view. Weak books create audit qualifications. Manipulated records may trigger fraud reporting obligations. This demonstrates why Section 128 is central to audit governance. Now let us discuss Secretarial governance relevance. Company secretaries frequently coordinate statutory compliance relating to maintenance location, board approvals, filings, and preservation systems. Secretarial auditors also examine whether accounting governance systems appear compliant structurally. Now let us discuss ROC filing implications. Where books are maintained at a place other than registered office, prescribed filing obligations arise. Failure to notify ROC may create compliance exposure. This is a common practical mistake. Now let us discuss a practical case study style illustration. Imagine a startup growing rapidly. Revenue increases dramatically. Investors become interested. But internally, accounting records remain chaotic. Invoices missing. Expense approvals undocumented. Related party transactions improperly recorded. No structured ERP system exists. Eventually, due diligence begins for investment funding. Investors discover weak accounting governance. Funding discussions collapse. This is how Section 128 compliance directly affects commercial growth. Now let us discuss another practical governance disaster. Suppose management manipulates accounting entries to inflate profits before IPO. Books appear compliant superficially. Later, forensic audit reveals fictitious transactions. Now directors, CFOs, auditors, and compliance professionals face investigations. Shareholder litigation begins. Market confidence collapses. This demonstrates why proper books are not merely technical records. They are legal evidence of corporate honesty. Now let us discuss connection with Section 129 relating to financial statements. Section 128 creates the accounting foundation. Section 129 governs presentation of financial statements. Without proper books, proper financial statements become impossible. Thus, both provisions operate together. Now let us discuss the connection with Section 134 regarding board's report. Directors certify financial governance quality partly based upon accounting systems. Weak books therefore create broader governance implications. Now let us discuss fraud risk. Section 128 often becomes central during investigations under Section 447 relating to fraud. Manipulated books may become evidence of intentional misconduct. This creates enormous liability exposure. Now let us discuss practical governance risks. Backdated entries, missing vouchers, improper related party accounting, cash transaction irregularities, inventory mismatches, revenue recognition manipulation, weak internal controls, unauthorized access to accounting systems. These risks directly affect Section 128 compliance. Now let us discuss hidden practical concepts. Books of account are not merely for statutory compliance. They are operational intelligence systems. Good accounting records improve strategic decision making. Weak records create management blindness. Thus, governance and business efficiency are interconnected. Now let us discuss applicability across company categories. Private companies remain fully covered. Public companies face broader scrutiny. Listed companies carry the highest governance expectations. OPCs also require proper accounting records despite simplified governance structures. Dormant companies must maintain records appropriate to their operations. Small companies may receive certain procedural relaxations elsewhere, but accounting integrity remains essential. Now let us discuss SEBI and securities law relevance. Listed companies face stringent disclosure expectations. Quarterly financial reporting, related party disclosures, audit committee oversight, insider trading monitoring, all depend upon reliable accounting records. Thus, Section 128 indirectly supports securities market integrity. Now, let us discuss income tax implications. Income tax assessments heavily depend upon books of account. Weak records may lead to disallowances, penalties, or reassessment exposure. Thus, Section 128 also intersects with tax governance. Now, let us discuss FEMA and RBI relevance. Foreign investment reporting, external commercial borrowings, and cross border transactions require accurate accounting systems. Poor books may trigger regulatory violations beyond company law. Now, let us discuss hidden exam traps. Students often assume books of account mean only physical registers. Incorrect. Electronic records are fully relevant. Another common mistake is ignoring preservation timelines. Students also confuse books of account with financial statements. These are different though interconnected concepts. Now let us discuss common compliance mistakes. Maintaining incomplete supporting records. Failure to preserve vouchers. Improper electronic backup systems. No board approval for alternate storage location. Weak internal financial controls. Poor branch reconciliation. Improper accounting software access controls. All these create governance vulnerability. Now let us discuss common ROC and regulatory issues. Failure to intimate alternate storage location. Inconsistent accounting records. Non-availability during inspection. Improper digital authentication systems. Weak audit trail preservation. These issues may trigger scrutiny. Now let us discuss due diligence perspectives. Investors, lenders, and acquirers examine accounting governance quality intensely. Clean books improve valuation confidence. Weak accounting discipline creates transaction risk. Thus, Section 128 compliance affects fundraising and commercial reputation directly. Now let us discuss secretarial audit perspectives. Though auditors primarily focus on financial review, secretarial governance professionals also assess structural accounting compliance systems indirectly. Repeated accounting irregularities create broader governance concerns. Now let us discuss the role of technology. Modern companies increasingly use AI-based accounting systems, ERP software, automated reconciliation, and cloud storage. But technology cannot replace governance ethics. Even sophisticated systems fail when management integrity collapses. Now let us discuss judicial principles. Courts and tribunals frequently treat books of account as critical evidentiary material. However, manipulated or unreliable books lose evidentiary value. This is extremely important in litigation. Now let us discuss practical drafting precautions. Maintain clear accounting policies. Preserve supporting documents systematically. Implement internal control frameworks. Conduct regular reconciliations. Monitor related party transactions carefully. Ensure board oversight over financial governance. Use secure digital systems with audit trails. These precautions strengthen governance credibility significantly. Now let us discuss one of the deepest governance insights connected with Section 128. Corporate governance ultimately depends upon financial truth. Directors make decisions based on numbers. Investors invest based on numbers. Banks lend based on numbers. Regulators monitor based on numbers. Markets react based on numbers. And those numbers originate from books of account. If books become unreliable, the entire governance ecosystem collapses. That is why Section 128 is so fundamentally important. For company secretaries, it supports compliance architecture. For chartered accountants, it forms the heart of audit integrity. For directors, it enables informed governance. For investors, it creates financial trust. For regulators, it enables accountability. For litigators, it provides evidentiary foundation. For students of corporate law, it demonstrates how documentation becomes the backbone of governance. And for modern corporate India, Section 128 stands as one of the most powerful reminders that successful corporate governance is not built merely on profits, branding, or market value. It is built on honest, transparent, accurate, and legally compliant books of account capable of revealing the true financial reality of the company at every moment. If you like this video, kindly like, subscribe, and hit the bell icon for latest notifications from Corporate and Securities Law Compass. Like, share, comment, subscribe. Disclaimer: viewing this video or accessing the content on this channel are free and does not create any professional, advisory, or client relationship between the speaker and the viewer. The content is shared solely for general educational and informational purposes. The speaker is a member of the Institute of Company Secretaries of India, ICSI. However, the information provided in this video should not be construed as professional advice, consultancy, or opinion under any law or regulation. Viewers should not rely solely on the information provided in this video for making legal, financial, regulatory, or compliance decisions. Any person intending to rely upon or act on the information contained herein should independently verify the relevant provisions of law and, where appropriate, seek professional advice from a qualified professional. The speaker, the Institute of Company Secretaries of India, ICSI, and any organization or listed company with which the speaker may be associated shall not be liable for any direct or indirect loss, damage, or consequences arising from reliance on the information provided in this video or channel. The content shared on this channel is based solely on publicly available information, general legal provisions, and academic discussion of corporate and regulatory frameworks. The speaker confirms that no unpublished price-sensitive information, UPSI, confidential information, or proprietary information of any listed company or organization has been disclosed or discussed in any video or content on this channel. The views expressed in the videos are personal academic interpretations for educational purposes only and are not connected with or derived from any confidential information obtained through employment, professional engagement, or association with any listed company or organization. Nothing contained in this channel should be interpreted as market advice, investment advice, or insider information under the applicable provisions of securities laws, including the SEBI Prohibition of Insider Trading Regulations 2015. Viewers are advised that the information shared is purely for general educational awareness and should not be relied upon for investment decisions, trading decisions, or regulatory compliance without consulting appropriate professionals and official sources.